Every year, millions of Americans over the age of 65 pay federal taxes they may not owe or pay significantly more than necessary. It's not because the IRS is charging them incorrectly. In many cases, it's because no one ever explained how the tax rules change once you reach retirement age or which tax breaks become available after 65. Today, we're going to look at 5 taxes that many older Americans continue paying, even though they may qualify for exemptions, deductions, or substantial reductions. In most situations, correcting the problem is surprisingly simple. It can be as easy as submitting one form, updating your records, or making a single phone call. Let's begin with the tax that leaves more retirement money unclaimed than any other: federal income tax. There is a new deduction that went into effect with the 2025 tax year that most seniors have never heard of. It is called the Senior Bonus Deduction, and it gives every person 65 or older an extra $4,000 off their taxable income on top of everything they already get. For a married couple where both spouses are 65 or older, that is $8,000. And that is in addition to the standard deduction, which for a single person 65 or older in 2026 is $18,250, and for a married couple both 65 or older is $30,750. Stack all of that together and a single senior can shelter over $22,000 of income from federal tax. A married couple both over 65 can shelter nearly $39,000. For millions of seniors living on Social Security plus a modest pension or a small IRA withdrawal, that means their federal income tax bill is zero, legitimately zero, and yet many of them are still having tax withheld from their Social Security check or their pension every single month out of pure habit because nobody told them to update their withholding. The fix is to look at your actual numbers, add up your total income, subtract your deductions, and see what you actually owe. If the answer is zero or close to it, file a new W-4P with your pension provider and a new W-4V with Social Security to stop the withholding. You are not avoiding taxes. You are stopping the government from holding your money all year and giving it back as a refund 12 months later. And here is what makes this urgent. The senior bonus deduction is temporary. It only exists for 2025 through 2028, 4 tax years. If Congress does not extend it, it disappears. So claim it every single year while it is here. If you use tax software, it will apply automatically when you enter your age. If someone prepares your return, ask them specifically whether they applied the senior bonus deduction. I will put all the details in the description. Tax number 2 is the tax on your Social Security benefits. And this is the one that confuses people the most because the rules are not straightforward. Whether your Social Security is taxed depends on something called provisional income. You take your adjusted gross income, add any tax-exempt interest, add half of your Social Security benefit, and the total determines how much of your Social Security is subject to tax. If you are single and that number is under $25,000, 0% of your Social Security is taxable. Between $25,000 and $34,000, up to 50% can be taxed. Above $34,000, up to 85% can be taxed. For married couples filing jointly, the thresholds are $32,000 and $44,000. Now, here is the part that actually matters. Even at the highest level, 15% of your Social Security is always tax-free. Always. And for a huge number of seniors, especially those whose primary income is Social Security plus a small amount from other sources, the combination of the standard deduction and the senior bonus deduction pushes their taxable income so low that their effective tax on Social Security is zero, even though technically a portion of it is taxable on paper. The mistake most seniors make is not running the math. They assume Social Security is fully taxed because someone told them it was, and they let the government withhold tax from their check every month without checking whether they actually owe anything. The W-4V form controls how much federal tax is withheld from your Social Security. You can set it to zero if your actual tax liability is zero. one form. I will put the details in the description. Tax number 3 is your state income tax on retirement income, and this is the one that could be worth more than all the others combined, depending on where you live. Right now, 42 states plus Washington, D.C. do not tax Social Security benefits at all. Only 8 states still tax Social Security in 2026, and those are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. And even in those 8 states, most of them exempt Social Security for seniors below certain income thresholds. But Social Security is only part of the picture. 13 states have no state income tax on any retirement income at all, including 401k withdrawals, IRA distributions, and pension payments. Those states are Alaska, Florida, Illinois, Iowa, Mississippi, Nevada, New Hampshire, Pennsylvania, South Dakota, Tennessee, Texas, Washington, and Wyoming. If you live in one of those states and you are paying a tax preparer to calculate state income tax on your retirement income, you are paying for a calculation that equals 0. And here is what catches people. Some seniors moved to a state years ago and never checked whether that state taxes their specific type of retirement income. Others are having state tax withheld from a pension that is being paid from a different state, and the rules about which state gets to tax that pension depend on where you live now, not where you worked. If you have moved since you're retired, or if you are thinking about moving, check your state's rules. The difference between a state that taxes your retirement income and one that does not can be $3,000, $5,000, even $10,000 a year. Tax number 4 is the Medicare surcharge, and most seniors do not even realize it is a tax. It is called IRMAA, the Income-Related Monthly Adjustment Amount, and it is an extra charge that gets added to your Medicare Part B and Part D premiums if your income is above a certain level. In 2026, the IRMAA thresholds start at $109,000 for a single filer and $218,000 for joint filers. The surcharge can add anywhere from $1,148 to $6,936 per year on top of your standard Medicare premiums. Now, here is the trap that hits retirees the hardest. Medicare uses your tax return from 2 years ago to calculate IRMAA. So if you retired in 2024 and your income drops significantly, Medicare is still looking at your 2024 return when you were earning a full salary. They see a high income number and they charge you the surcharge based on money you are no longer earning. The fix is a form called the SSA 44. It is a one-page form that lets you tell Social Security that you have had a life-changing event and retirement is specifically on the list. You file the form, you show your current income, and they recalculate your premiums based on what you are actually earning now instead of what you earned 2 years ago. I've seen this single form save people between $1,000 and almost $7,000 in a single year. Filing it takes about 15 minutes. Most people do not know it exists. I will put the details in the tax number 5 is your property tax. And this one is local, not federal. But for most seniors, it is the single biggest tax bill they pay every year. And in almost every case, they are paying more than they have to. Nearly every state in the country offers some form of property tax relief for homeowners over 65. The names vary by state. Some call it a senior breaker credit, but the principle is the same. Once you reach a certain age, typically 65, you can reduce the taxable value of your home or freeze your tax bill so it stops climbing, even if your home's market value goes up. In Texas, the over 65 exemption reduces your taxable home value by an additional $60,000 for school district taxes and freezes your school tax at the level it was the year you turned 65. That freeze has no income limit. It applies to every homeowner over 65, regardless of wealth. In New York, the Enhanced Star exemption and the new senior property tax exemption that took effect in 2026 can reduce your school taxes by up to 65% of your home's assessed value. In Florida, the additional homestead exemption for seniors can exempt up to $50,000 of assessed value if your household income is under a certain threshold. The catch is always the same. None of these are automatic. Your county does not look at your birthday and apply the discount. You have to file an application. And in many states, the application has a hard deadline early in the year. Miss the deadline and you pay full price for another 12 months. One phone call to your county tax assessor's office is all it takes. Ask what senior exemptions are available and whether any of them have no income limit. That single call can be worth $1,000 to $5,000 a year for the rest of your life. Let me bring all five together. The senior bonus deduction can push your federal tax to zero. The Social Security tax may not apply to you at all, depending on your income level. Your state may not tax retirement income whatsoever. The IRMAA surcharge can be appealed and eliminated with one form if you have recently retired. And your property tax almost certainly has a senior exemption or freeze that you have not claimed. Every one of these is legal. Every one of them is available right now. And every one of them requires you to take action because the government does not refund taxes you overpaid out of ignorance. They do not send you a letter saying you qualify for a lower rate. They do not adjust your withholding because you turned 65. The system takes what you give it, and it gives back only what you ask for. I will put every form number, every phone number, and every link you need in the description below. Send this to one person over 60 who is still paying taxes they do not owe. A parent, a sibling, a friend, someone at church. The odds are very good that at least one of these five taxes is coming out of their pocket right now for no reason. And one share from you could put real money back where it belongs. I will see you in the next one.